Okay, and then I've got the master class itself open because I liked some of the illustrations that I think we'll use tonight in the discussion that we have. And again, I want to emphasize that it's just simply a discussion. I'm not teaching anything. I'm just trying to facilitate conversation about the material. So help me keep the conversation lively and ask questions or make comments, observations, and I'll just kind of occasionally remind new people coming onto the call that that's what we want to do. Is it's more to be a discussion group where we kind of share our ideas. So just to get started tonight, we're going to focus on risk, particularly risk as it relates to financial crises. And again, we're on pages 65 through, let's see, 72, I believe. Yep, 72 of the book, if you have the book in front of you. And we're in that section here of the master class, if you recognize this part of the master class from the illustration where I've shared my screen. But to kick it off, Ben talks about in order for the risk-adjusted performance to be accurately measured, we have to go through what he refers to as a complete business cycle that includes some kind of significant financial crises, and factor that historical data into our prospective information as we adjust it for that risk. Any thoughts on that as to why that needs to happen? And there's a big hint over here on my screen.
Mark, I don't think a lot of not very many investors do that.
They don't.
Do any of them do that?
No, yeah, you're right. This is Ben's real strategic value-added secret. This is his secret sauce.
Yeah, they talk a lot about returns and liquidity, and they kind of skirt around risk.
Mm-hmm. That's exactly right. If you go back and you look at some of the earlier information that Adagio presents in his initial material, he talks about how during these years from 2007, 2008, 2009, he was able to make double-digit returns while everybody else was, losing money. And so that's exactly right, Jodi. This is his secret sauce, as it were. We might look at other funds, we might look at other people setting up funds and things like that, but unless they're using Adagio's risk-adjusted performance measurements, they're not really taking into account this historical data. And he makes the point that, I'm going to get to that in just a minute, but as he was including historical data that included an entire business cycle, and especially since 2007, 2008, that has been kind of the key metric that he's focused on, is basically back test your data going through that 2008 financial crisis and before, or you're not taking into account all your risk. And
Mark, do you think on his risk adjusted performance, do you think that could be done for any fund or any investment, or is that specific to a real estate investment?
Personally, the way I understand the master class is that Ben says this will apply to anything, because if you take, for example, let's take for example a private equity fund. Okay, even private equity funds had data that they could access through the 2008 financial crisis. Obviously, as we look here, the Dow Jones fell 54% over almost a 2.5-year period. Standard & Poor's lost 57%, and then the housing lost even less, but still lost enough during that period of time to lose all your equity. So the point being is, if you can track data through that Dow Jones, through that Standard & Poor's, any other data that they were tracking during that time, you can apply it to whatever investment you're probably considering. And that's my understanding of it, is that it's designed to be to anything.
Yeah, that was my understanding too.
So, looking at that, I don't know how old you guys are, but were you of age during 2008? I mean, were you
Yes.
guys working in your professions and your careers during that time, or were you
Yes.
still in college or, high school?
No, well,
I was working.
You were working. Okay, so you
Yeah.
you felt the effects of 2007, 2008 very keenly, I'm sure.
Yes.
Okay. How about you, Toby?
mhm.
Okay. Well, that's good, because some of the things that we can consider here, we can draw upon that experience from just 12, 14 years ago. I mean, I was in 2008, I was still, I was in my late 40s. And so yeah, I can vividly remember, almost day to day what it felt like going through that. In fact, I'll bring up a couple of stories later on if it's worth sharing.
It still pisses me off that we gave all that money to the government to bail out banks.
Oh yeah, that was that this whole concept of too big to fail is
Yeah, that's horse
such an
crap.
insult to my intelligence. It's like, no, they're supposed to fail. That's the whole idea. The idea, if you go back and look at other crises in the past, they were designed, first of all, they were calculated to adjust for inefficiency, ineffectiveness, those kinds of things. And in this case, those particular banks were being inefficient, ineffective. They had long outlived the evolutionary cycle from a business standpoint. They should have been allowed to fail, and society would have reconstructed itself under a new world, as it were, based on those having failed. And instead, we ended up with white elephants and dinosaurs. So yeah, you're exactly right there. What were your thoughts about the housing market back then, as far as people, I remember, reading about people, in California and other places where they were so far upside down on their mortgages, as much as this 27%. And basically these people just handed the keys of their house back to the bank and walked away. What were your thoughts on that when that was happening?
Well, I don't know that, I mean, because we were in real estate at the time.
Mm-hmm.
And so in a way it was a little bit easier to maneuver, because at the time, my husband was doing fix and flips and I was, the real estate agent.
Mm-hmm.
And it wasn't as scary on the buy, because you knew you were kind of at the bottom, if that makes sense.
Yes, absolutely. It was the time to buy. In December 2011, it was time to buy, and people were afraid to buy at that point.
Well, whereas now in our market, it has appreciated so rapidly, so quickly. It kind of feels faux, like this faux market that we're in. I don't know, that it's kind of scary, because you don't know, are you buying, can it go any higher? And I've been saying that for like 6 years. Can the market go any higher? And it does.
Keeps going.
Yeah. And
Mm-hmm.
I'm just like waiting. But it's kind of, I think, a little bit more scary, because if you buy today and the market crashes tomorrow, you're in a world of, it's a whole different thing.
Yeah. Do you remember from the last chapter, we talked about the odd lot theory? Do you remember what that was?
I don't.
You remember? I'll read it and tell me, you guys, how this applies to this current housing market. Okay. The odd lot theory was this. Ben quotes it like this: the lemming-like masses, often guided by their financial advisors, get excited and overly optimistic when the market is about to top. And they tend to get fearful and overly pessimistic when the market's about to bottom. In other words, they're moving contrary to the market in an unhealthy way. How does that sync up with today's housing market, do you think?
Me personally, I feel like, and I haven't been able to prove this with any sort of data, but what I've been hearing, and I'm not sure if it's happening so much where we are, Toby, but I have heard of like BlackRock coming in and buying up whole communities of houses, and then renting them. So to me, it kind of feels like, I don't know, it feels kind of manipulated. I don't feel like we're in a true market.
Mm-hmm. And I would give you some data to support that, that it feels manipulated, because it is manipulated.
Mhm.
I was just looking, this is kind of in line with this topic. It might be a sidetrack, but it's kind of in line with the topic. Recently, I was looking at some inflation data, and there's a website out there, and I've got to remember where it was that somebody sent me to. But essentially, the CPI that's calculated today is not the same basket of goods and services that calculated the CPI back in 1980 or even 1990. In other words, the inflation rate, when we talk about the inflation rate hitting 20% or whatever it was back in 1980 with Jimmy Carter, it's not the same CPI as today. They've manipulated that by substituting goods and services into that basket that generate the CPI today. And it's not, with different items. And it's a way to artificially suppress the inflation rate. And of course, who's over the inflation? Who through monetary policy tries to manage inflation? It's these guys sitting there with his picture on the page there, Mr. Bernanke, and at that point in time. Now it's
Right.
Jerome, what's his face? But Jerome Powell. But what that means is that if you compare the CPI basket from 1980 to today's inflation basket and put it back the way it was in 1980, our inflation rate isn't 6.5%, 7% or whatever it is they reported recently year over year. It's 16%. Okay. So when you're looking at, a true inflation rate right now of 16% plus, then you got to come to the same conclusion, Jodi, that you just have, which is something's not right, something's manipulated, and there's a rat in the woodpile, as they say.
Right. A big rat.
A big rat in the woodpile. And so that's what a lot of this financial crisis is designed to take care of as best we can. Obviously, he goes on to say that you can't predict everything. You've got black swan events that come along, and it's hard to predict those. But one thing you can do, and he talks about the short memory, the short-term memory that everyone seems to have when it comes to financial crises. Now let's see if I can move this forward. There we go. So check this out. This is a history of actual financial crises. And essentially what point Ben is trying to make here is that if you don't go back, you'll see that there's a financial crisis almost every 10 years, going back to 1982 here in this picture. And even as far back as 1971, when Nixon closed the gold window. And I don't know that you guys are old enough to remember that one, but I was 12 years old at the time, and I was aware enough of what was going on. We talked about it in my social studies class in junior high, and so I distinctly remember. I don't think my junior high social studies teacher was particularly a fan of Nixon at the time, and I wasn't really that into what was left and right at that point. I was just kind of a kid taking it all in. But I do remember the jokes that he used to make about Nixon, and particularly Nixon's policies. And so that's why I remember it. So I remember my teacher telling all these jokes about it. But he talked about the closing of the gold window, and that's how I remember it. And I heard a barrage of jokes. But but as you can see here in this chart, there's about every 10 years something that's going to affect that market in a big way. And so what are your thoughts on that as far as what you see or perceive Ben has been doing?
Well, we just had one in 2020.
Mm-hmm. Yep.
We got threats of war now, devaluing of the dollar, and it can be, the market could still crash again.
Yeah, I think, Toby, I agree. And I think those are precursors. I think we still have more to come in 2022. Yeah. Jodi?
I was trying to find, because I have been getting these email, and there's something, it's called COP26. I haven't done my own research on this yet, but apparently it was a big meeting attended by Biden, Boris Johnson, Justin Trudeau, Emmanuel Macron, Janet Yellen, and all these, Elon Musk and Bezos were there.
Now, what was it called again? CPO 26?
COP26 in Glasgow, Scotland. And it's saying that the world leaders are committing to a $150 trillion global transition of our economy.
Mm-hmm. It's probably part of the Great Reset, as they call it.
World Economic Forum.
And it was Bank of America signed on with 131 countries, 234 cities, and 695 of the world's biggest companies.
Mm-hmm.
So I haven't done my own research on that and to find out, what all that means, but something's definitely percolating.
Oh yeah. It's been percolating for some time. I'm just curious as to how many of those 64 countries that weren't present, who those were. I'd be interested.
Right.
Huh?
Right. Well, I mean, to me, it's amazing if you go and look at the World Economic Forum and the stuff that they put out and the big companies that have signed on to that. I'm just like, are you insane?
Mm-hmm.
Are you insane, people? It's unreal.
Well, you're definitely talking about an elite class, the same class of people that formed the Federal Reserve Bank and the central banks of all of those countries. There are people who believe in central planning. I can speak with Ben quite conversantly on this point because we both have libertarian leanings in our economics and in our financial and fiscal policy attitudes. And yeah, this has been coming together for since 1913 and before. Since just before 1913. And if you go back to The Creature from Jekyll Island, which we're going to talk a little bit about later on here in this meeting.
Yep.
Which I've got to get that book.
Oh yeah, it's a great book. I thought I was going to put my hands on it, and I need to reorder it because I can't put my hands on it right away.
Although I think if I read it, I might get really angry.
Probably.
Yes.
You guys listen to George Gammon on YouTube?
How's that?
George Gammon on YouTube. He makes really informative macroeconomic videos.
Mm-hmm.
And he breaks things down to the super simple.
So
Yeah.
This
Does he
brings me
interview
to-
people?
He's usually the one getting interviewed.
Oh, okay. Jodi, I'm sorry.
no, you're fine. I was just going to say, this brings me to kind of how I kind of understand what Ben's doing a little bit with using, at least this is my understanding. When I ran it by Stefan, he's like, yeah, I think you get it. But Ben is using like financial mechanisms like calls, puts, derivatives within our monetary system to create the returns, the risk adjusted returns to investors.
Yes, he's using all kinds of tools and techniques in his toolbox, if you will, to create these structured products. And I like the name structured product because that's exactly what he's doing. He's taking and structuring a product around these tools and types of products, if you will, and combining them in a way to work a certain way so that when things economically go a certain way, the product is able to function and deliver the return. What do you got there, Toby?
I was just looking to see if Creature from Jekyll Island is on Audible, and it is. And it's
It
It should
is
be. Yeah.
24 hours.
It's been around. Let's see, Creature of Jekyll Island.
74 hours.
24.
Oh, 24.
It's a big book.
Wow.
Pretty, yeah, it's pretty good size.
It's that thick, you know. So yeah, it's
Oh, yeah,
it's a
I
big book.
definitely gotta
I read
get
it when it first came out. I think in '95 or '6 was when
Griffin.
Griffin. He's got another initial in there. I'm trying to remember. Anyway, yeah, Griffin came out with that about '95 or '96.
Yeah, G.
So
Edward.
it's been 27 years since he wrote the first edition of that.
Wow.
And I had just finished reading another book about the Federal Reserve called Secrets of the Temple. And that's another one that goes into how it was formed and by whom and what they did and the purposes for it and so forth. And you know, and it's interesting because the linking of the Federal Reserve Act in 1913 also had a large impact on the 16th Amendment, which was also ratified, notice my air quotes, ratified in 1913 as well. And there's a real story behind the ratification. That's why I put that in air quotes.
Huh.
So I'll let you guys research that one on your own.
That website
See,
you were
the more-
talking about is Shadow Stats for the CPI.
that?
Shadow
Yes.
Stats for the CPI.
Yeah, Shadow Stats. That's it. That's the one. Okay, so what we're concluding here basically is that many people, and it goes right back to your point, Jodi, many people, when they consider the risk of a particular investment opportunity in a structured product, whatever you want to call it, depending on what it might be, they have this short memory and they forget that there's these financial crises that happen every 10 years or so, and they need to factor that in as they back test their investments, and they seldom do. Hence the quantitative financial tools that Ben has developed and even patented to, or it's patent pending. I don't remember. I could have that wrong, but he's got it as intellectual property. So it's unique to him, and nobody else is using it. And so, quite frankly, that's why I think I mentioned to you the other day when we were talking that I would hope that everything we consider in terms of investment possibilities, even the real estate deals and so forth, and non-real estate deals, we run through Adagio, we get that good housekeeping seal of approval that I was talking about, which includes the risk adjusted performance measurement on the back testing data.
Hey, Mark, do
Yeah.
you know if he's updated it for COVID for 2020?
Well, he's
Is risk
developed a series of mathematical equations. You're now getting into quantitative financials. And so I would have to again say, yes, I believe, because it's a set of formulas, it's not a set of necessarily fixed rules. it's a set of formulas. And so when you plug in data, if you've got COVID data in there, yeah, it's going to factor that in. So if you're looking at it for 2021, that had COVID impact on there, you know, in terms of a financial impact, 2020 will. And so you're going to see a curve that looks kind of like this from a timeline. You're going to see a curve that incorporates pre-2008. It's going to go up, you know, over the decade. It's going to hit 2020 and 2021. It's going to do that, right? And so, yeah, I would imagine that definitely it includes that data.
Yeah, I think it uses 4 different measures of risk.
Yes, there are actually, and we're not going to get into that until a future discussion. But yeah, there's actually 4 different measures of risk. He's got the names on there. He introduces, I think, kurtosis and what's the other one? Skewness in this lesson. But he doesn't really define them other than he makes reference to what they mean. But yeah, those are 2 of the 4, and then he's got 2 more. And those are all formula based. And so in the spreadsheet that he's developed, he apparently, obviously, I should say, goes through and addresses those formulations, and you run your data through it, in which case, if you have 2020 and 2021 data, you're going to be picking up that risk for 220 and 221 and eventually 2022 as well.
So Mark, you think that could be used on like a private equity fund that's purchasing like small businesses?
Mm-hmm. Yeah, that's what we're talking about. It applies to any kind of investment, because again, his risk-adjusted performance measurement is not unique to any particular industry or any particular type of investment or what have you. You basically are running data through it, and it's calculating risk. You know, and if you look at his risk formulas, and I don't want to get off track on this too far, because like I said, we're going to have a very detailed conversation about that here in the near future. But if you look at those formulas, they're not product specific. They are not industry specific. These are mathematical equations that are designed to calculate risk, period. And so you're now taking data and you're funneling it through the calculations, right? It's just a mathematical algorithm. And you're funneling data through that. Well, does it have a prejudice to whatever kind of data you're flowing through there? No. And so you could have, you know, a number of data sets, say out of private equity. You know, what are you looking at? You're looking at, you know, EBITDA, you're looking at economic factors that didn't change from industry to industry, so it doesn't matter what kind of industry. You're looking at, you know, possibly revenues, other data sets and things like that related to your private equity, and you're funneling it all through that, you know, mathematical equation. And, you know, again, I don't pretend to know how it all comes together, but through that spreadsheet, I want to get my hands on that spreadsheet here, the not too distant future, where we can learn how to play with this. And I can probably speak to it much better. But no, it's not intended to be product specific, industry specific, you know, fund specific. It should be anything that you run through that data, you know, the data sets that you run through that. Does that make sense?
Yeah.
Okay. So that's why, and again, I'm kind of going back to the other kind of meeting, but that's why I would take any investment opportunity that we're considering, whether it's from Adagio. Well, obviously Adagio has gone through that, so you can assume that due diligence has been performed on the Adagio products, right? But if you have something out there that you think might be a really incredibly great deal, then, you know, that's where I would hope to approach Adagio and approach Ben and say, okay, we need to do our due diligence, and here's the due diligence we've done so far. What other due diligence do we need to gather to be able to run it through your risk-adjusted model? You know, and he may say, well, I need this data set, that data set, another data set that you haven't got here. Okay, we'll go get that data. We'll run it from 2022, you know, March of 2022 or April of 2022, all the way back through 2021, 2020, back past 2008, you know, 2007, you know, get a good 15, 16 years of data is what he's saying. And then we'll
Right.
bring those data sets back up, run them through, and then see what the conclusions are at that point. Whether they can say, yep, adjusted for those risks, had you survived 2007, 2008, 2009, this is what your returns would have been. And if you can demonstrate that your returns would have been a successful return and you've factored that risk into it, then now you can move forward with a high degree of confidence that, unless we have something worse than 2008, then, you're going to be in good shape. And remember, Bernanke classified 2008 as the worst financial crisis in the history of global history, including the Great Depression. So, if that is true, if Bernanke was speaking truth, and I have no reason to doubt that evaluation, he wasn't as politicized as some of the more recent chairmen have been, right? He was still trying to act, I think, somewhat neutral, politically speaking. And so, I have no reason to doubt his assessment when he says that was the worst financial crisis in global history. So essentially, if you can pass muster, having done the stress test of 2007, 2008, and 2009, you've got a pretty good chance of making it going forward, unless there's a black swan event that's far worse. If that makes sense. Any other thoughts or questions at this point? No, or I'll introduce something new here.
Well, just that we're really due for something even bigger.
Yeah.
We're like in an everything bubble.
Yep, an everything bubble.
And investors are worried about that. So they're looking for places to put their money other than stock market for sure.
Mm-hmm.
A lot are flocking to real estate, but even that's getting scary.
Mm-hmm. Yeah, because they've commoditized real estate as well.
Oh, yeah.
And so you're now going to be suffering, the similar kinds of issues.
Which is a great thing for us. Oh.
Yeah, yeah.
Because
yeah. Go ahead. Tell me why.
Well, because we can offer something that no one else is. You're going to know your risk adjusted performance in the investment, which no one else offers.
Mm-hmm.
And it's an alternative to stocks, bonds, and mutual funds.
Mm-hmm. Why else might it be a good time? And I'm thinking primarily odd lot theory.
Are you thinking because people are expecting something bad?
Yep, people are panicking, and so they're dumping, and they're going to be dumping at deep discounts. It reminds me again of George Bailey in The Wonderful Life, that scene where, he's trying to keep the doors open, because he's got to run on his little savings and loan, he makes the comment to the people who now are afraid, right? They're wanting, take their money out of the savings and loan, and they're commenting on Mr. Potter over across the street at the bank, who was buying their deposits for pennies on the dollar because they were panicked, and it took George Bailey sitting there going, hey guys, Mr. Potter's not selling, he's buying your panic, right?
Hey.
And so, it took people to realize, wait a minute, he's not doing us any favors here. And, that way, old George Bailey was able to keep his doors open during that time, even though he was just as vulnerable. But
I don't think people are panicking in real estate yet, but they're selling because they do feel like we're at the top of the market, or they're trying to capitalize on that. But nobody's.
Yeah, and I tell everybody everybody who asks me or talks to me about it, I say, sell now. We don't know where the absolute top is any more than we know where the absolute bottom is. Mm-hmm. But we're at a point where we all know that this is not natural, right? And so the time to get out, whether it tops out a year from now, 2 years from now, 10 years from now, it's an unnatural situation. If you're going to get out now and get some really good profits, take your profits and go. Get out now and don't risk trying to find the absolute top and now finding yourself holding, a white elephant at the bottom,
Yep.
And so, yeah, I'm trying to be the counterintuitive or go against the odd lot theory, where everybody's rushing in right now, let's get out. And, if there's some things, and Jodi, I don't mean that to say that we shouldn't, do real estate deals. Don't get me wrong.
Just do great
The
deals.
incredible real estate deals that we look for are those undervalued assets or underpriced assets that you can make
Ha ha ha.
make a profit on, whether they go up or down. The banks make money, and again, we're kind of moving out there on the front edge of banks' money making processes. But the point being is Ben is teaching that he made money whether the deal went up or whether the deal went down. He still made money. And when you master that, when you master that formulation and structure your deals that way, then it doesn't matter where the market's going to go, whether it's up or down, you're still going to make money on it. And so when I say I'm talking about people getting out, I'm talking about people who are really, they bought their home when it cost $200,000 and the home's selling for $1 million, in the one-off situations. That's what I'm talking about now. I just needed to clarify that, I think, that, I'm talking about individuals and their homes more than I am talking about real estate in general or as an investment.
Well, that's why what he did with the hard money stuff was just ingenious to me.
Yes, absolutely. So let me ask this question. Okay, there's a really intriguing statement that Ben makes on page 67, where he talks about the Federal Reserve, which is the prime issuer of the US dollar, reported itself insolvent on a mark-to-market basis in the third quarter of 2018. What does that mean to you? Now, I know Jodi knows what mark-to-market is. She's a CPA, so she knows GAAP. Toby, are you familiar with the mark-to-market concept? Okay. Jodi, you want to explain real quick to Toby what mark-to-market is basically, or
oh boy, you're going to make me go. You're going to make me go all the way back into my accounting studies. Basically, my understanding of it, and I could be way off, is that they're taking their assets that they have on their books and they're adjusting it up or down to the market. And when they did that, that means they were at zero. Right?
Oh, go ahead. Sorry.
Is that right?
Yeah. Back in my day, when I, punched my CPA ticket over 35 years ago, it was a very hard line accounting principle that you recorded everything at its historic value.
Right.
And so everything was, and it was something that was drilled into us as accountants and CPAs, right? Just it's historic value. It's historic value. And you ignored on the balance sheet the market value of those assets. Well, there was always the argument that you should probably consider a market valuation. And of course, if you sold that historic asset, then the difference between your market and your historic cost was part of your gain, obviously. But GAAP, they came out, I don't remember how long ago now, it's been a while, but they came out with another financial accounting standard, which basically says now under certain circumstances and certain methodologies, you got to market. And essentially it's taking the assets, basically all the elements of your balance sheet and determining what the fair market value is and marking those assets to that. And of course, there's, notes in the financials that have to discuss the historic value versus the market value and why they did what they did and so on and so forth. It just made more work for the CPAs and their audits, right?
And probably allowed for more manipulation.
And allowed for more manipulation, which is funny, because you had the Dingle committee and they went through this whole thing to finally get Sarbanes-Oxley in place, and now they start mark to market. Yeah, there's some
oh my
some
gosh.
really interesting inconsistencies there. But yeah, what you're saying there is that in Q3 2018, the Federal Reserve Bank took those assets, marked them to market, which in most cases meant they had to mark them down, right? The historical cost was here, and market said, no, they're not worth that much. You have to mark it down, take the loss, and now they're insolvent. The Federal Reserve Bank is bankrupt in the literal sense. You know, from the standpoint of if you're looking at those assets, their fair market value, the Federal Reserve Bank is bankrupt as of Q3 2018. They may have worked their way out of it by now. We're in 2022, so we're now coming up on 4 years later. Maybe that's changed, but not likely.
Well, with inflation, there probably is.
Possibly with some inflation.
There had to be something behind the scenes though that made them want to do that, Mark. Why? What would make them want to do that?
I honestly don't know. I'm not in Jerome Powell's head or Janet Yellen's. I guess she was the chairman at the time. Or no, maybe it was Powell by then. But anyway, no, I'm not in his head. I would have to study that and to do some old tricks that and that's do some analytical review, look at some other things in context with that move, and determine why they might have done that. Keep in mind there's a number of factors there, and I'm getting kind of off the page, but there's a number of factors there that the Federal Reserve Bank has never been audited, so they're trying to self-audit audit themselves, which means they're probably trying to create the appearance of the independence that they allege to have, even though they're not. And so, the question is did they say, okay, if we don't mark to market, they'll probably audit us because that's no longer a gap accepted. Historic value is no longer gap accepted. We've got to mark to market. And they probably just let the chips fall where they may. I don't know. I'm just speculating at this point. But anyway, the key thing that I gleaned from that was that if our Federal Reserve, if our central bank, because again, since Keynes, they want to go to central planning. And that was part of having a central bank. Is to do central economic planning through their monetary policy and the government through its fiscal policy. And so, be that as it may, how many other central banks around the world are equally insolvent? Because they're all doing the same thing. All of them. That's the inference that I wanted people listening to this to take away from that. Is that, yeah. And so, if we had another 2008 crisis, what does that mean? Our Federal Reserve Bank cannot bail out those that are too big to fail. Okay, because now it's going to be the Federal Reserve that's failing, not the banks and the insurance companies that failed in 2008. Does that make sense?
Well, and that's why I think they're doing that COP26 meeting.
Yeah. Yeah.
Because what this gal was saying was that it wasn't so much another big crash. It's going to be a total transformation.
Yeah. And what
she called it was a distortion.
Yes, a distortion. And so let's take this to a different point, because the Federal Reserve is responsible for managing inflation. And we've already talked about how the inflation has been artificially held down and manipulated. Is there another way that the Federal Reserve has artificially held down inflation and basically leading to this COP26 and what might come out of it? And I'm thinking Bretton Woods, just as a hint. You know what I'm referring to?
No.
Okay. So when the Bretton Woods Accord was signed, I believe, in 1948. It was after World War II, and it's what ultimately established the dollar as the world's reserve currency. Okay.
Oh.
where everything on an international trade basis had to be traded in dollars. Okay. And so the dollars that we create through government spending and Federal Reserve printing is used throughout the world. It's not just our M2 supply here in the United States. Our M2 supply, shall I say, dollars in the marketplace go way beyond our M2 supply on an international scale. And so we were effectively exporting our inflation, meaning that those dollars got exported out of the United States, no longer part of the M2 supply. They're now getting exported. The countries are being forced to trade with, inflated or lower value dollars than before. And so they're now bearing the brunt of our inflation. And we're sitting here high on the hog because we're not experiencing the actual inflation of our dollars because those dollars are chasing goods outside the country. Now, what happens when the COP26 says, guess what, guys? We're not going to go with the dollar as the reserve currency anymore. We're going to go through with a basket of currencies. In fact, that basket of currencies has been around since 1971. And now we are no longer going to use the dollar as the reserve currency. What does that mean? All that inflation is going to come home to roost. So we think we're feeling inflation now. Have you guys ever lived through hyperinflation? You know what hyperinflation is?
Not here.
No, we've never had hyperinflation here. I had an interesting experience about 42 years ago. I was a young man of about 19, 20 years old. And I spent some time in Argentina. In fact, I was there for about 2 years. And to give you an idea of what it meant to live through hyperinflation in Argentina at that time, and Argentina's inflation at that time, by the way, was not that bad compared to some hyperinflations. I've seen 30,000% inflation in Peru in the 1980s. You've seen inflation in some of these African democratic republics that are socialist, like Zimbabwe, where they, are spending billions of dollars for a loaf of bread. It's the proverbial push cart. What is it? Anyway, full of money, to buy bread. And so when I was in Argentina, like I said, it wasn't quite that bad yet, but it was hyperinflation because it was well over 100% a year. And to give you an example of how it affected me personally, when I was there, my parents sent me about $125 a month when I first started there. I got there in March of '79, and they were sending me $125 a month to live on. And $125 a month, believe it or not, paid for my apartment, paid for all my food. I was able to pay a lady to wash my clothes for me every week. I was able to, buy tickets on the bus to drive all over town or ride all over town. I mean, everything I could possibly need fit well within that $125 budget in March of 1979. By the time I came home 2 years later, or nearly 2 years later, in January of 1981, I was asking my parents to send me well in excess of $500 a month. And that $500 a month paid for my apartment and one meal a day.
That's crazy.
That's it. So it went
You're
from
like, I'm going back.
Huh?
You're like, I'm
What's
going
that?
back. They probably wanted you to go back.
Yeah. So, it not only can you see the multiplier effect in the dollars that were spent, but you can also see the multiplier effect in the services that I could afford to buy with those dollars in just 2 years. And so that's called living through hyperinflation. And, and obviously I wasn't that concerned about it. I came out of it untainted. It's all cool. But people around here at this generation, at this day and age, have no idea what it feels like to live in hyperinflation. And yet we are at a very high risk of having hyperinflation hit us. You know, and it's interesting because hyperinflation wasn't noticeable in 2007 through 2009. But the inflation that I think we're going to be experiencing, based on the things you guys are talking about, correctly identified, is going to result in a hyperinflationary state. It's going to go way above 20% before it's all over.
Well, my 16 is kind of getting a taste of it.
How's that?
My 16-year-old's kind of getting a taste of it, having to put gas in the car.
Oh yeah. Yep. Okay. Well, now we've
minor.
identified risk. I'm sorry, Toby, go ahead.
I'm saying that's just relatively minor to what could happen.
Yeah.
Exactly.
Yeah. I can tell you another funny story about gasoline. I've got all kinds of stories, but I distinctly remember in 1974, when we got hit by the Arab oil embargo and the fuel crisis that attended that in 1974. Prior to that, I remember distinctly. I mean, I'm old enough to remember. I was 15 years old, and so before that, it cost about 32 to 33 cents a gallon where I was living at the time. Gasoline did. And as a result of 1974, by the end of 74, we were probably at about 55 to 60 cents a gallon. Okay. Ooh. Go back to those days, right? But
Right.
I remember it was a really funny experience. My dad and I were driving, and my dad needed to fill up the car. And he pulled into a gas station, and he looked at the gas tank, and he looked at or gas pump, and he looked at the prices on the pump, and he just quietly put it back in gear and drove away. And I said, Dad, you stopped for gas. We need gas. Why didn't you buy gas? I saw the price. I could see that he was like cringing at 55 cents a gallon. And he was cringing. And I said, we need gas. And he goes, not at that price, we don't. And I'm sure he finally got used to 55 cents a gallon, obviously, but it was pretty funny. You know, how many of you have ever had to experience that, had that experience, go up to the gas pump and drive away and go, not at that price, I'm not buying.
Oh, every time I've wanted to, except I wouldn't get to drive very far.
That's right. You just kind of by force have to do it. Oh, I'm having fun times adjusting my camera here. All right, well, let's continue. We're going a little slow, but I think it's important. I think Ben spent this time writing this and putting this in the course. It's that important that we really recognize that one of the biggest reasons why we have to consider financial crises in our data flow, in considering a risk-adjusted performance measurement. Let's talk a little bit more about risk in statistical terms now, briefly. He gives us 3 examples. The first one he gives is the risk analysis in the coin flip. You remember that?
Mm-hmm.
Anybody want to speak to that?
Yeah, you basically have a 50-50 chance on heads or tails.
Oops, sorry. Go ahead.
So, yeah, so this slide here. So if you were to bet $1 and a 50-50 chance, you multiply that by 2, or you divide by 0.5.
Mm-hmm.
You get $2.
And that's what would be your fair return.
Fair return, like an average bet. So you anything higher than that, you take that bet. So if you're to get 250, that's good. If it's $1.50, then don't take that bet.
Right. Does anybody have any questions about that example of risk? I think that one's pretty easy to get our heads around. Anybody? Jodi, do you have any thoughts or questions about that?
No.
Okay, I'm going to insert this one question, and it's more hypothetical because I get it. But the one thing that hangs people up the most, if you guys took any stats in school, is this 50%. Okay, because it's always going to be 50% no matter what. You got heads and tails. What a lot of people get hung up on in terms of probabilities here in this coin flip is they somehow seem to think that the longer you go, say bringing up heads, the more likelihood there is that you're going to bring up tails. Does that make sense? Did you hear that objection in stats? And of course the stats professor stood up there and he just pounded the table and said, no, it's still 50%, right? And they go, but what if, remember that conversation?
Yep.
I'm sure every class has it.
Yeah.
And so I just wanted to mention that for those who may be coming along behind us and, are going, well, wait a minute, I didn't take stats. Why wouldn't that probability change, depending on, whether you're getting a running streak with heads or tails, right? And the answer is no, it won't change. It's always 50% no matter what. So I just wanted to clarify that. I was hoping one of you guys would bring that up, but okay. All right, so that takes care of that. That one's pretty easy to handle. Let's take the case of the 2.5 billion% return. Let's see if I can bring this up. I don't see a graphic, but I'll bring it up.
Higher outcome example of 175.
Okay, so here's the Powerball example. Jodi, did you explain the coin flip, or was that Toby? I don't remember.
That was Toby.
Okay, you want to take a crack at this one?
Oh Lord.
It's the same concept, just bigger numbers.
Yeah, it is.
I don't want to put you on the spot. If you don't feel comfortable, don't feel like you have to.
Well, what was interesting, and I'm driving, so I'm not looking at it.
Okay.
I'm going back in my memory when I was reading that part.
Okay.
But what was
I'm going to be
interesting-
impressed.
What was interesting to me when I was reading through that part was, kind of the same concept of, your probability, I guess, of winning, but that the majority of that dollar, because if I want to say it was like was it like 14 cents?
Mm-hmm. Yeah,
that actually, related to the payout, and the rest of it was all profit. Am I saying that right?
Yep.
For the Powerball, the lottery itself.
Right. Mm-hmm.
And I was like, what? I need to show that to my dad because he plays the lottery every week.
That's
religiously.
That's why my dad always used to say the lottery is a tax on the stupid.
Yes, it actually is.
I always like to say I win every time I don't play.
That's right. You win every time you don't play. But the point here that Ben is making, and Jodi, you nailed it, is that basically there is a calculation that you can do that determines what would be a fair return and the probability where you've got true risk happening without the loaded price, obviously, and it is 14 cents. And at that point in time, at 14 cents, it becomes a fair bet. The other 86 cents is the tax on the stupid. Okay, if they were paying 14 cents for that tax, okay, it's like flipping a coin. Play the game, right? But
right.
But yeah, it's more of the same concept, and it's driving the point home through this case of the Powerball that again you've got a lopsided probability of losing, and how much you could afford to invest and have it be a fair probability of losing or winning. And so that's exactly right. Let's see, I underlined something here. I underlined everything. Let me just read this real quick. It says on the bottom of page 68, how can you possibly know if you're paying a fair price for an investment with this story-based approach to risk analysis? Okay, and the answer is?
You can't.
You can't. Okay, and I think what he's trying to emphasize here is essentially that, again, risk is a number. It's not a story. It's not, a relationship. It's a number, and you can calculate it, and you can factor it against your anticipated returns and adjust accordingly, and then determine, if it's a fair bet or not. And that's in essence what he's doing with the Powerball example here. He's saying, okay, you've got the chance of winning all of this money, but you got to adjust that for, your odds, and you shouldn't pay more than 14 cents for that investment. And that's only then at kind of a break-even point. That's not a lopsided or a fat tail risk that we're going to get into in a second in your favor. And so, yeah. Let's go on. And again, to your point, the answer is you can't. The good news, he says, is you can flip the script. And I like that because that's probably code for what's his name? Let's see.
Oren
Clough, who wrote Flip the Script, because Ben has recommended that to everybody to read. Have you guys read it?
Yeah.
It's
I'm
great.
reading it
I
right
loved
now.
it.
Oh,
I read it over Christmas. Yep. Okay, so let's talk about the soldier's bad bet and tail risk. Toby, you want to take that one on?
Sure.
Okay. That's on page 69, if you want to reference it. Let's see if I can pull it up here.
Let's start with the definition of risk is the probability of loss weighted by the potential degree of that loss. And so I think in this example, you're really talking about the not necessarily the probability of loss, because the probability is super low, but the potential degree of that loss is super high.
That's the skewness, isn't it?
Yeah.
Yeah, skewed distribution. So yeah, the kid who's enlisting, because the recruiter there at his high school is telling him he's going to get his college paid for, and he's going to have this great career, and all these wonderful things are going to happen. By the way, I was into it.
And the reward isn't even that high.
Yeah, and the reward isn't even that high, and that's
of
why you see on that skewed curve down there, a nominal fixed low-level reward in relation to the risk you're taking. Now, the risk you're taking is very low probability, but the risk is infinite, meaning that you could get called to battle and die, right? And so that's what we're talking about there in terms of a bad bet and a tail risk when you're looking at those kind of probabilities. The opposite, though, can be had when you're investing in certain kinds of investments. And this goes back to Jodi, what you were talking about early on in the conversation, where the skewness, if you will, is going the other direction. You know an example of an investment that goes that direction, where the risk of loss is relatively low compared to the amount of gain you could have?
Say that again, Mark.
Okay, so we just now talked about tail risk with respect to the soldier, which is not a good risk. But I said essentially there are investment opportunities that flip that curve. Imagine that curve there at the bottom of the screen, where the risk of loss looks like that low risk thing there on the right is now on the left, and your tail risk going to the right is now big, like the tail risk going to the left there is. So now what that means is it's a type of, say, an investment that has a very limited risk of loss and tons of upward potential. Have you thought of an investment that does that?
I can't say that I have. I think a lot of people, I wouldn't say a ton on the upside. I don't know if this is what you're getting at, but I think some people think like an investment in treasuries or what they think is more stable has the lower risk with the,
with today's interest rate, so that's a guaranteed loss.
Mhm.
With today's interest rates,
Right.
that's a guaranteed loss. So no, I'm thinking more
Right.
along the lines of options, where you have a limit to how much you can lose and you have tons of upward potential, right? Because you've fixed your investment price at a certain rate, and yet you're buying options, you're not buying the actual stock. And yet when you
Oh,
realize
gotcha.
the return on that option, you're going to be way out there in that fat tail going the other direction. Does that make sense?
Yeah.
Okay.
Is it
So I
it's
just-
kind of like betting when you're betting basketball games, the over under,
Uh-huh.
kind of.
Yep. Okay. So let's continue on this then. So basically, and I think this is another one of the points that Ben's trying to make with this example, is essentially the shadow banking world as a whole is trying to learn how to flip that tail risk to your advantage. And it kind of goes back to that concept of heads I win, tails I win, right?
Heads I
No
win.
matter
Right.
what happens, you want to be in the winning position.
You either win or
Um,
you win bigger.
Yeah, but you never lose. You never lose.
Right.
And so I was explaining this concept, and I think this is probably a lot of what Ben was thinking back in 2008. I can't say I've gotten into his head, but back then he was into hard money lending, right? And so I'm thinking, as a hard money lender now, what would I be doing? Well, I would be limiting my loan to value ratios down to a very conservative amount. And for starters, and that again is after taking into account all the risk, right? Requiring them to come up with some kind of equity play, and that would be the start. I was just sharing with a person not a couple weeks ago. We were talking about this very same concept, because I was essentially suggesting that he do this real estate deal with some hard money on it. And it's a small deal. It's not an Adagio level deal. It's just a guy doing a fix and flip on his house, really. But I was taking on the same concept. I say, these guys are loaning you money based on a heads I win, tails I win philosophy. And he was saying, well, how do I get there? How do I get to that same level? And I said, well, be just a little more conservative than the lender. If the lender is going to lend you 60 cents on the dollar, 60% loan to value, okay, then if you get to that 60% and you're looking like you're not done on the project yet, you're going to have to go out and borrow more. Why don't you sell it at that point? Let the buyer take the risk from that point in time that he buys from you, because he's going to look at it and say, well, I don't understand risk, right? And I'm getting this for 75 cents on the dollar, right? And so you can sell it for 75 cents on the dollar, pay off your 60 cents, and you walk away with 15 grand in your pocket. Okay, heads you win, tails you win. And so, and like Toby said, one you win, the other one you win big, but at least you're not losing, because you figured out a way to set your formula up so that you win either way. And that's what I believe, Ben was discovering back in 2008. And that's why he was able to fly over the top of everybody with that, was it 40% return where everybody else was hitting negative. He was doing something that got him that heads I win, tails I win result. And so, whether it was exactly what I just outlined on this guy's house or something totally different, I don't know, but it was that concept. That makes sense?
Yeah.
Okay.
Yeah.
Cool. Let's see. On page 70, he defines convexity and kurtosis. So I wanted to spend a little bit of time talking about those definitions so that everybody was kind of clear on that. He said, okay, so he said, but for now, suffice it to say that buying options creates that positive convexity. In other words, it takes that tail risk and flips it around the other direction. And he calls that positive convexity. Okay, I hope everybody can make that connection. And then it's a small, and again, it's described as small potential loss exposure with potentially infinite upside. Okay, and so and those can protect you from tail risk, which is the one that he showed in the picture. Okay, and that tail risk is defined mathematically as kurtosis. So if you take this let's see if I don't know if I'm pointing at it right here. If you take this tail risk here that we're talking about with the soldier having the infinite downside and the limited upside, that's called kurtosis. All right, and if you flip it over the other direction, like using options in an investment, that's called positive convexity, as I understand those definitions. Anybody have any thoughts on that?
Sounds right.
Okay, cool. So we've talked about tail risk a little bit more there on page 70. I think I'll leave that alone for now. I think we've got it risk pretty much covered at this point. But let's go back to, for the last 3 to 5 minutes, and then we'll wrap this up. Let's go back to the socialization of risk, okay? Because that's what happened. That's what happened in 1913 with the creation of the Federal Reserve Bank. The bottom line is, and again, this is all in The Creature from Jekyll Island. I'll bring that book cover up just so that people can see what that looks like.
Positive downside. So you do the big investment bank.
Okay, so there's the book right there, Creature from Jekyll Island by G. Edward Griffin. It was Edward I was forgetting. I was calling him G. Griffin, and I knew it wasn't it. G. Edward Griffin. And so anyway, Griffin is talking about the socialization of risk with the formation of the Federal Reserve as far back as 1913. Why? Because back then, banks had made bad loans, kind of like 2008, leading up to 2008. Banks had been making bad loans, and they didn't want to take the risk of those bad loans. They didn't want to eat the bad loans. They didn't want to take the risk of having those bad loans take the banks down. They were, quote, too big to fail. And so they formed the Federal Reserve Bank, which a component of it, as Ben has described, was private banking structure, and a component of it was public. But the bottom line is that they wanted the taxpayer to foot the bill if they made bad loans. The socialization of risk. Okay, and so what they did, their motives in 1913 to create the Federal Reserve Bank were exactly the same motives that they had in 2007 through 9 to then socialize that risk. All those banks that were too big to fail, AIG is an insurance company, was too big to fail. Who foot the bill for that?
Taxpayers.
We did.
We did, yeah.
Okay. And so what they did once again in 2008 was to socialize the risk of those bank failures.
The fat cats kept their big checks, their big
And
bonuses
they kept their big checks.
for making bad decisions.
It was the most self-serving, act that I can imagine on the part of the executives of those institutions, especially the ones that were bailed out. Self-serving.
They should have all been fired.
Fired, and what else?
Jail.
Jailed.
The best and easiest way to rob a bank is to own one. Seriously. In fact, I think a guy wrote a book by that name. And it's interesting because, a part of my accounting career, was very much involved in financial history. You guys probably may not remember what a savings and loan was. In the late 80s, from about 1985 to 1990, I was auditing savings and loans. Okay. Those were the little George Bailey type banks. Okay. They weren't banks, they were savings and loans. They literally had home mortgages on the one side and savings accounts on the other. Okay. And from a retail banking standpoint, some of them might have offered checking. Sometimes they didn't. I audited a savings and loan for about 5 years out of Grants Pass, Oregon. That's all they did. They had a passbook savings account product. That was it on the retail side. And they offered home loans. That was it. as a savings and loan. And because they didn't get involved in any of these other commercial banking things, and because their underwriting standards were still good, and because of their executive management of the savings and loan, they actually survived the S&L crisis of 1991, 92. And so they were still in business. All the other savings and loans that I audited back then were gone by 1992. And so, and why? Because they were making bad loans. They were making self-serving loans. You know, the CEOs of those savings and loans were involved in some of the biggest retail scams, or real estate scams, I should say, real estate scams that you'd ever imagine. And that's why I said, even back then, the best way to rob a bank, I said, best way to rob an S&L, the best way to rob a bank was to own one.
You know what, Mark? It's funny because I think in the book, Ben has a chart of all the consolidation of all the banks.
Yes, yeah, that's coming up.
And it's really interesting how that's, I don't know, been orchestrated maybe. But because there used to be tons of banks and now there are very few.
Yep, they've been consolidated. They've gone out of, most of them have just been gobbled up.
Right.
Because when they get in trouble, a bigger fish will come along and just swallow them up, so that we don't have bank failures, hitting the headlines, things like that. There's one other aspect of the socialization of risk that we ought to touch on because it's in the headlines today. And I think we need to talk about that. And that is inflation. We've talked a little bit about inflation today. We've talked a little bit about how you lose buying power, and that's what Ben is referring to on pages 71 and 72. But let's, for the sake of posterity, I know you guys get it, but for the sake of posterity, let's talk about what inflation is and how it's caused. Okay, because there's a lot of theories out there. I mean, we got President Biden, blaming inflation right now on Putin. Okay. And so let's talk about what inflation really is and help anybody who comes along behind this that doesn't really know what inflation is and have this conversation for their benefit. So what is the definition of inflation? And I'm basically going to warn you, don't go to the symptoms because the symptoms are not the definition. What is the definition or essential cause of inflation?
Like the devaluation of your money through printing.
Yes, exactly. And how is money printed?
Created.
How's it created? There's one vehicle that creates.
The Fed.
Huh? The Fed's creating. The Fed's doing it. The Fed's running the presses, right? Based on debt. It's
right.
Because of the fractional reserve banking, and I'm actually putting the cart before the horse. I want to blame it I'm going to lay it at the feet of government first. But there is a component that is also laid at the feet of the consumer. Government overspends what they take in. And so what do? They borrow money from the Fed, who prints it on this fractional reserve basis. They create it out of the proverbial thin air. Okay. And so what is that doing? That's creating more dollars coming into the system, into the M2 supply. And so you have too many dollars chasing too few goods. And that is the very definition of inflation. Too many dollars chasing too few goods. I'm taking you back to your economics 101 class, right? Too many dollars chasing too few goods. Okay. It didn't say Putin printed the dollars. Okay. The Fed printed the dollars. And that's because the federal government authorized them to print the dollars because they overspent. Okay. I think one of the reasons why the federal government likes the Fed is because they can print the dollars while authorizing the spending, but they go, well, we didn't bring the money into existence. The Fed did, right? It's those guys. and the Fed's going, no, it's how you're spending, and basically both are to blame, but it's Tweedledee and Tweedledum, as it were. But essentially, it's the federal government borrowing more than they take in, thus creating the dollars. Now you have more dollars in the money supply chasing too few goods. And that, by definition, is inflation. The other part where I was, essentially laying it at the feet of the consumer is a similar concept. When you borrow money, whether it's to borrow money for that mortgage or those credit cards or that automobile, because the banks can do fractional reserve banking and effectively create that money out of thin air, your act of borrowing, that $500,000 you're borrowing to buy that house, was created out of thin air. So therefore, your mortgage was an inflationary act. It put $500,000 into the money supply that wasn't there an hour ago. Does that make sense? And same thing when you use your credit card. Same thing you do when you buy a car. I mean, all that debt that's created comes through the mechanism of the fractional reserve banking system, and therefore is a creation of a new dollar, and is therefore inflationary. So it's not just the government; we as consumers do it too.
Well, and it was interesting. I think Ben said in the book that the bankers win when we're in high inflation.
Oh, absolutely. Yep.
Yeah.
Yep, that's right. In fact, this is a great one to quit on. At the bottom of page 72, Peter Schiff is quoted by Ben as saying, he wished he could buy the CPI, that's the inflation index, because it's eternally positive gains. Well, I'm going to show you effectively how to do just that, Ben says. He's going to show us how to buy that CPI. So I'll leave that as the teaser for next time. But anyway, any last comments about inflation, the socialization of risk here, risk in general, what we covered tonight?
I don't think I have anything more to add. It makes my brain hurt.
Yeah, pisses me off.
Yeah,
I was
that too.
At one point in time, I thought I would go pick up an advanced degree at von Mises Institute, which is the Austrian School of Economics, Hayek and those guys, Peter Schiff. And I got busy and decided I couldn't do it. But this is these are pages right out of the Austrian School of Economics. And it's the kind of economics that the libertarian mind follows and focuses on for the most part. So anyway, good. We'll call it a night. And I thank both of you for being here. It was a lively and good conversation. I think this is going to make a great archive for those that couldn't make it tonight. And we'll let them watch this and ponder on risk. So
well, thank you, Mark. As always, you lead the conversation well.
Well, thank you. I appreciate it. And look forward to next week.
All right.
Take care, everybody.
Bye.
Bye-bye.